Hello, Dr. Wang is here. Today we're gonna move on to the Proforma analysis, and Proforma basically means the forecasted. So if I'm going to insert a new row and I'm going to rename it as 2017, however, it is a Proforma or forecasted year for all the accounting items. It's not really an actual number, so I need to mark it as a Proforma. Okay, and what we encountered in the classroom that got my whole procedure messed up was this. So if you check the formulas and you check these calculation options, make sure this is automatic, okay? So the classroom computer made it as manual, and that created a lot of problems when I lecture the same thing. So when it's checked as a manual, all right, if I put a 10 plus 1, and right here I want it to be 10 plus 1. The answer is 11, that's for sure. But if I change this as 20, then you see this just doesn't automatically compute. So what I should do is I will make sure this is automatic, okay, not manual, automatic. So if I hit automatic, then this will compute. All right, like here, 10 plus 2, it should be 12. Okay. So if I change this to 3, the sum should change to 5. Okay. So that's the first thing we should put. And also we have a forecasted sales. So for the sales in history, we're gonna forecast for the new year of 2017, and I'm going to use the trend function, and my y's would be the sales, and my axis would be all the year, and I have a new year as a forecaster. The forecasted would be this new sale. So I'm going to change the format a little bit. So this is a $4.3 million is my sale in the next year. That's the forecasted. And then I went back to my income statement and link this sale in the 2017 to the forecasted sales here. Okay, so I got a $4.3, and then I changed the format a little bit. Okay, so for the majority of this, I have covered in class, but I don't mind to do it again. You will see that for cost goods sold, SG&A expenses on the Proforma analysis or on the income statement, it should be as a portion to sales. So I assume that this cost of sales would be the same as a percentage for 2017. It's the same for 2016 and also 2015. So I'm going to take the average of the same ratio of 16 and use a comma to separate this ratio of 2015, all right, and then multiplied by the sales in the new year, okay? And the gross profit would be the sales minus the forecasted cost of goods sold, all right? So decrease decimal. The SG&A expense just follow the same method. The average of the ratio SG&A divided by sales for 2016, and the same ratio for 2015 times the sales in the new year. Okay, the fixed expense is still the same, and depreciation expense is the existing depreciation that is happening each year plus $5,000 more depreciation. Okay, so that's 25. So EBIT is your gross profit minus the sum of the three expenses, and your interest expense is basically 10% of the short-term and the long-term debts, and in the balance sheet I'm going to create a Proforma year, okay, and the short-term and long-term debt would assume to be the same. Okay, let me zoom in a little bit. All right, so for my interest, for my interest expense, it is the interest rate of 10% times the amount of a debt, okay, which is a short term, and then plus long term. Okay, so that's my interest expense. And then for earning before taxes is my EBIT minus interest expense. All right, for taxes is my earning before taxes times the tax rate. All right, the net income is taxable income minus taxes, and the dividend is the same as last year, which is 22,000. Okay, so that's it for the Proforma income statement for now. And if I move to the balance sheet, then I will need to fill out all these numbers. The cash is assumed to be the same as last year for account receivable. So the technique we did in class is to create a new window. So view, new window, and then I'm going to hit the view button again, render the windows vertically. So on one of the window, I want to show income statement, the other balance sheet. Okay, so why do I need to do this? Because if I calculate the account receivable for the Proforma year, then I will keep using the sales in the income statement in another sheet. So I just don't want to transfer from one sheet to another. That's gonna be very messy. So here is how it should go. So average of the account receivable for 16 divided by sales for 16, comma, then account receivable for 15 divided by sales for 15, okay? And then the whole thing will be multiplied by the sales for 17. Okay? And then decrease decimal. All right, for inventory, I just do it the same way again. So it's an inventory of a 16 divided by sales in the 16, comma, the inventory of a 15 divided by sales of 15 times sales of 2017. Okay. All right, and then the total current assets is a summation of all three items. All right, plant equipment is whatever you had before plus the New Year's addition. Okay, and accumulated depreciation basically is your depreciation last year plus the depreciation expense this year. All right, and my net fixed assets is this total plant equipment minus accumulated depreciation. Total assets will be equals to a total current plus net fixed. So this is accounting. I just go through this very fast. And for accounts payables, we're going to use the same method as the account receivable. So what you do here is using the same method, average account payable of a 16 divided by sales of 16, and then 15 divided by the AP of 15 divided by sales of 15. All right, then the average multiplied by sales in the 2017. All right, and you're gonna use the same method again for accruals. So this accrual of a 16. Oh, sorry, this should be average. The accruals of a 16 divided by sales of a 16, okay, comma, accruals of 15, which is D16, okay, divided by sales of 2015, and then the average will be multiplied by the sales of 17, okay, so on and so forth. Okay, sorry, it was my son. He is playing. All right. And then the total current liabilities would be a summation of all three. Okay. And then the total liabilities would be the total current plus the long-term liability. All right. And the common stock keeps the same. Retained earnings is the retained earning last year plus the net income in this year minus dividend in this year. Okay, and then the total share equity is my common stock plus this retained earnings, and then my total liabilities would be my total debt, which is right here, plus this total shareholders equity.